All right. Hello, everybody. Welcome. I am a few hours late, as you can see, because it's already dark behind me, but let's just jump right in. So welcome to Money Matters. I am your host, Hung Lu. I'm with Cash Property Inc. And today we're going to be talking about the pros and cons of increased amortization. And I'm assuming that you know what amortization is. This has to do with your mortgage. So now before we jump into that, there's a couple of shout outs that I need to put out. The first one is the mastermind. It's happening this Friday. So if you are interested in connecting on the mastermind, we do some networking. We do a real estate sharing topic. If you're interested in attending the mastermind, please comment below, put mastermind on there. We'll make sure that we get you an invite to the mastermind. The other thing is it's Remembrance Day. So I wanted just to do a big shout out to all of the families and the individuals who serve on our military. Thank you so much for all of the work that you do. Thank you for the heartache and the pain. Yeah, there's just been, I would not have all the freedoms that I have and have the amazing life that I have in Canada if it wasn't for all of the individuals who serve as part of the military. So thank you so very much for that. All right, so let's get into this. So before I go into the calculations, just keep in mind that any of the ideas and the advice that I share with you, please go and check with a mortgage agent, with your accountant, lawyer. Make sure you double check the information. What I'm presenting may not be a good fit for you. Okay. I'm doing these to connect with other accredited investors, put out sound, sensible advice to help people make money in real estate and have that confidence to be able to make those decisions. However, my risk tolerance is very different from somebody else's. So just putting that out there. So let me bring up the Excel sheet. On that note, we'll get right into it. So we're going to be talking about the pros and cons of increased amortization. And the reason why this is a really big topic right now is because we are actually seeing options where we're able to increase our amortization from 25 to 30 years for first-time home buyers. For investors where we're buying multifamily buildings, we're actually seeing an increase potentially. We are seeing that already, up to 50 years of amortization for some of our multi-unit buildings. And so understanding the effect of increasing that amortization, pro and con, will help you make the right decisions. Okay. So the great thing about being able to have a higher amortization is, one, it will reduce your monthly payments or your payments on a steady basis to a smaller amount. So making it more affordable, which is one of the reasons why they're increasing the 25 to 30 years for first-time home buyers. And then for the multifamily unit buildings, the reason why they're increasing it is because now the monthly payment is smaller, so that as the investors, we're cash flowing more. Okay, now there is a bunch of negatives that go with it. Okay, think of it this way. You're basically taking a 25-year mortgage and you're adding another 5 years to it. So now you have a mortgage longer. Okay, a lot of us are already going to be owning our homes in our 60s and 70s, and now we're adding another 5 years potentially to that. And with some of these multifamilies, some of the investors we're talking about are saying, Hung, you know what? I only have another 5 or 10 years to invest, and then I'm going to be selling them. Why would I buy a building and have it for 50 years if I'm never going to be able to pay it off? Okay. So there is, that negative side of increasing the amortization. The biggest, consideration is, how much is it going to cost you to increase your amortization, whether it's an extra year or 5 years or, going up to 50. So right now, in the economic times that we're seeing, a lot of us are looking for ways to increase our cash flow. And one of the ways to do that is to go and increase your amortization if you can, right? Some lenders right now are not charging a penalty. Like, there's no penalty to increase your amortization. Some allow it depending on the type of mortgage you have. So if you're able to increase your amortization, okay, it doesn't matter how much longer you're increasing it for, it's automatically going to decrease your monthly payments. And so it should open up some more cash flow for you. So let's go into the spreadsheet. So on the screen, you should see the spreadsheet. And let me bring this up just a little bit. Okay. Now, if you want this spreadsheet, here it is on this website here. Like I downloaded this, I don't know how many years ago. So I've been playing around with this spreadsheet for years and years, and it's one of the ones that I like to use. And because of that is, I'm a numbers person, but also because there's a very nice graph that goes with this. And I'll explain a little bit more about this graph, but it comes with this graph and it's very like, a picture says 1,000 words, right? So let's go through this example here, and then I'll show you what it means to increase the amortization from 25 years to 30 years, or to go from 30 to 50 for, say, a multifamily building. Okay, so let's run this loan let's go up to $1 million. Okay, because a lot of times we're talking about these things and we're saying, oh, it's going to be 500,000 or whatever, but we're actually seeing a lot of the loans now around 800,000 to $1 million. Okay, some I've seen are a lot higher than this, right? So a range, but let's just, for this case, let's run it at $1 million, 5% interest rate. We're running it at 25 years. The date, it doesn't matter. Just for this example, we're using this date, semi-annually compounded. We're paying monthly. Okay, so what this tells me is that the monthly payment for this is $5,800. Okay, that means every single month you have to pay $5,800 to principal and interest. And I've put down here 5 years. So that means that it's a term of 5 years. And then at the end of the 5 terms, you have to renegotiate, assuming that everything continues on. By the end of your 25 years, you would be paid off your mortgage. And so you would pay $1 million off your mortgage. At the same time, you would have paid a total, okay, of 1.377. So that's your total number of payments, and your total interest that you would have paid at that point is $640,000. Okay. So the first thing I hope that pops out is that you're paying 50% more for your property. So your property is $1 million. Now, technically, you've paid 1.64. Okay. Think of that. Like you're paying quite a lot in interest there. Okay. So now what's going to happen is, okay, so now let's go into, so I'm not going to change any of the other stuff here. What I'm going to do is just go and change this 25 to 30. Okay. Now, before I do that, what I want to show you is, okay, based on $1 million, okay, you are not going to be paying. So up until year 11, you're going to be paying more money every single month towards your interest, this pink line. You're paying more money to your interest every single month for 11 years. And it's only after your 11th year that more of your payments every single month, assuming that the interest and everything stays the same and you haven't missed any payments, you're not doing any double ups or anything like that. Consistently, if you paid every single month, it's only after your 11th year that your $5,800 a month will actually start going more towards your principal than to your interest. Okay, that is a big deal. Okay, now this number has increased quite a bit because in the past, when I used to run these scenarios, the mortgages were 500,000, 600, 700. Now we're looking at mortgages up to $1 million. So really, if you are selling your home and moving within this 11-year time frame, you haven't actually paid any, like you haven't made a big dent in your mortgage because most of it has been going to interest. Okay, let that sink in. Like that is a huge amount of interest to be paying to the bank, and you actually won't see that effect on your principal until year 11. That's massive. Okay, so now it's easier to see if the numbers is 500,000. So I'm going to go back and just show you what 500,000 looks like here. Okay. Okay, now why did that not go? Ooh, okay, so here we go. So in this case here, we went to 500,000, and yeah, the monthly there. Okay, so you can see here that it takes a very long time before, you see any interest, the interest coming down below the principal. Okay, so here now, okay, so let's go back to $1 million. All right, so we're up to $1 million there. Okay, so now what we're going to do is we're going to increase the 25 years up to 30 years. And just by doing that, you're going to see a change in the graph. You're also going to see a change in the outstanding balance at the end of your 5 years. Okay. And okay, so this is a good number to look at here. So you see the interest paid is 234. The principal paid is 114. So you've actually paid almost double in interest in those 5 years. So, which is what this graph is showing you, right? Like you're paying double the amount towards your interest than actually towards paying down your principal on your mortgage. Okay, so the outstanding balance at the end of year 5 is 885,000. Okay, so let's just now increase this to 30 years, and you're going to see the effect of this. So now we're going to increase this to 30 years. So now look what happens to the monthly payments. They went down by about $500. So what that means is by increasing your amortization by 5 years, you've put back $500 a month into your cash flow, into your available disposable income. Okay. Now, I'm not saying that that's $500 for you to go and have dinners or travel or whatever. It's $500 to help you pay off other things like the cost of living. Okay. So that $500 is a big deal for a lot of families right now. Okay, now look at this. The principal amount that you've paid off instead of 114,000 is 82,000. So your principal amount has actually gone down significantly. So what is that? Like another 20, 30,000, like 30 more thousand, like it's, you basically didn't pay off 30,000 of your principal. Okay, your interest is, I think it was about a 234. So it's about the same. Okay. Now look at and then your outstanding balance, it's still north of 917,000, right? So whereas previously it was like 890,000. Okay. So you can see the effect just from 5 years. Yes, you've decreased your monthly payment. So that opens it up for you to have a little bit more cash flow, but now it's going to take you a lot long. Well, because it's going to take you an extra 5 years. Okay. So the amount of interest that you've paid down is less, and you've paid way more in interest. Okay. So now the interesting to keep in mind is that now, instead of it being at 11 years where you would see more going towards your principal and less starting to go towards your interest, you're now at year 16 before you even start seeing those two lines cross. Okay. That is a big deal. Okay. Like basically you're spending another 5 years, basically paying more towards your interest than towards your principal. Okay. Now this increase in amortization is fantastic depending on how you want to look at it, right? Like it's that whole concept of the, is a cup of water half full, or a cup with half filled with water, is it half full or half empty? Okay. So now let's just say we're going to increase this now to 50 years for a multifamily. Okay. So now we're going to go up to 50 years. Okay. So you're going to see the difference here. So now the great thing about increasing it to 50 years is now our monthly our monthly payment is 4,500. Okay. This is a big deal for multifamilies because now we've got, to go from, let's say, the 25 years that we were at up to 50 years. Okay. So I'm going to go just put 25 there so you could see. So from 5,800 to 4,005, that's $1,300 back in our pockets as investors for us to take as cash flow to pay dividends to our money partners for investing with us, or to build up that reserve so that if something went wrong at the apartment building, we would have the reserve to pay the renovations or the repairs. And also at the same time, it's cash back in our pockets, right? To make sure that the deals are viable for all of us. Okay. So now the thing to keep in mind though, is that now your interest payments after 5 years, okay, and your principal pay down, okay, the interest payment, your principal pay down is only $25,000. compared to like the 88,000 or the 90,000 even. Okay. So in this 5 years, we would have only paid down 25%. So this is where you need to run your numbers to say, okay, if I've got money partners and we're only going to see a 25%, sorry, a 25K down payment we're going to see $25,000 in mortgage pay down over 5 years. If you divide that by 5 years, that's actually not that much in mortgage pay down. Okay. So that means when you're calculating your ROI, it's going to really affect your ROI calculation. Okay. So now, okay, so I want to, so before I go into that ROI calculation, I just want to make sure that I've covered all the notes here. Yeah. Okay. So before I go into the ROI calculation, I just want to make sure that I mentioned this part too. So many people are in favor of this increased amortization because it decreases the monthly payments and it increases our cash flow. Now, there are some potential negatives that happen with this though. By making the monthly payments more affordable, you are going to have more people entering into the housing market. Okay, hands down, that's why the amortization increases are happening, right? Is to encourage people to get into the housing market. Okay, great. If more people are getting into the housing market and they're adding in, let's say, a duplex, an in-law suite, adding in a garden suite, and now you've got 2 or 3 units on one lot, okay? Well, what's going to happen now is you're going to increase demand on houses. The minute you increase demand on houses, you're going to increase the value. You're going to increase the purchase price. You're going to increase the future value of these buildings so that when they do go out for sale or when other opportunity, like when other properties come up for sale, they're going to be at the higher value. So now you're also driving the prices of these houses. Okay. So keep that in mind that, yeah, there's a benefit of increasing the amortization, which is decreasing the monthly payments so that people can get into houses and potentially buy multifamilies or small multifamilies. But at the same time, it is going to drive prices up. Okay. And so if you're looking to acquire properties, it's not necessarily a good thing. If you're holding on to properties, well, that's a fantastic thing because you want to be able to count on that prices going up and it's part of the appreciation. And then you go to the bank and you pull out that equity, right? Which is way better than the cash flow portion from the monthly pay down or from your NOIs, right? The equity pullout is completely tax-free. Right? It's treated, it's a different type of tax classification. So you're definitely going to want to talk to your accountant about that if what I just said doesn't make any sense. Okay, so let's go into, let me see if I have one of these built in here already. I don't think I do. Okay, so let's do a quick calculation here about ROI then. Okay, let's see if I can do this quickly here. So let's see. Okay, we're going to go in here and I'm going to just add in a new cell here and we're going to type in ROI for that. Okay, I'm going to make this a little bit bigger so you can see what I'm doing. Okay, so usually for the ROI, what you want to consider is you want to consider your cash flow, your mortgage pay down. Okay, pay down. Okay, appreciation. Okay, and I know I did spell that wrong. Okay, so now we're talking about a passive appreciation and forced appreciation. Okay, so I'm going to assume here that there is no forced appreciation here. Okay, because you would have seen that forced appreciation from the point that you got the new mortgage. Okay, so I'm going to assume that your forced appreciation is 0%. 0%. Okay, so now if you've got a cash flow here, so let's just say your cash flow is $100,000 a year. Okay. So I'm just pulling this number out. So the cash flow is your incomes. So your rents, your laundry, storage, whatever sort of cash flow you've got coming in from the opportunity, less all of your expenses. Okay. So insurance, property taxes, you know, all of your expenses minus your mortgage payments. Okay. So let's just say that cash flow is per year. Okay. $100,000. Okay. And we're just going to run it with 100 and then we'll run in another example with it going up based on the increased amortization. Okay. So what we're going to do is we're going to say this is pre-increase. Okay. Pre-increase. Okay. Amort. Okay. And then we'll run another example with it being post-increase. So meaning that you've increased it. Okay. Just to show you what the effect would be. And as I'm building this, because I'm building this spreadsheet, I've never actually run this calculation. So it'll be interesting for me to also see that as well. Okay. So this is also per year. Okay. So now let's just say the mortgage pay down in this case. So let's go back over here to here. We're going to go back to 25 years. Okay. So the principal pay down in 5 years was 114,000. So let's just go into here. We're going to put in 114.3 just as a rough number. Okay. Just to show you the idea behind this. Okay. And then the appreciation, let's just say that it's 5% per year. Okay. And so for us to have gotten $1 million in a mortgage, 1, 2, 3, is that $1 million there? Okay. So that means that we would have had to put down 20%. Okay. So the mortgage would have been this amount. So that means that the original value, okay, let's just say we had $200,000. So the original value would have been not 12 million. That would have been funny. Okay. So 1.2 million, let's just say. Okay. So then 5% appreciation on 1.2 million. Okay. Is simply just 5% times your 1.2 million. So it would have gone up by 60,000 every single year, which is fantastic. So then that means at the end of that 1 year, my building would, or my property would be worth 1.26. Okay. And then what's going to happen is that the second year, it's going to go up by 5% again. So I'm just running it, with some easy numbers here. Okay. So that means then it's going to be 5% times my 1.26. Okay. So you'll see here that it went up by an extra 3,000 because what's happening is I'm getting appreciation on the previous year's appreciation. Okay. So I'm compounding on the compound. Okay. Which is a super fantastic thing. So now what's going to happen is, oh, it's not times, it's plus. Okay. So then to figure out what the appreciation is at the end of the second year, you just add the first year's value plus the 63,000, which is the appreciation for that 1 year. And that will get you 1.3. Okay. So, which is massive. Like if you think about the compounding here. Okay. So at the end of 5 years, so this would be 1, 2, 3, 4, 5. Okay. So at the end of my 5th year, my building would be worth $1.5 million. Okay. So now this is the same thing for your house. Like, so if you're watching this and you're like, well, I don't have a building yet. Okay. It doesn't matter. Okay. Because here's the thing. If your house is worth 1.2, by the end of your 5 years, your house would be worth 1.5. Okay. This appreciation is one reason why anybody who's debating about getting into real estate, oh, Hung, you know what? I would rather rent than buy. Okay. This is one of the reasons why owning a home just makes way more sense than renting. Okay. Because you're having this passive compounding on compound interest every single year. Like this appreciation is like the magic of math, right? Okay. So that means at the end of my 5 years, my appreciation here, okay, it's not going to be 1.5. It's going to be 1.5 less my 1.2. So that means, look at that, $331,000 in appreciation. Okay, that's massive. Okay, so now what I'm going to do is I'm just going to add a couple more lines here so you could see this. Okay, so that means in total, with my cash flow, mortgage pay down, and appreciation, okay, and we don't have any forced appreciation here, okay, we would have seen $545,000. Okay, now we're talking about 5 years here, so hold on. So I need to go, okay, this is per year. So I need to divide this by 5. Okay, so let me go back and I will divide that by 5. Okay, and so this is per year. And then this mortgage also needs to be divided by 5. Okay, because that 114,000 was for a 5-year period. Okay, so every single year, I'm getting 100,000 in cash flow. The mortgage pay down is 22,000 per year. And then the appreciation 66,000 per year. Okay. So here you can see the time value of money, right? The first year was only 60. The second year was 63. But when you take the average of those 5 years, it's actually $66,000, which is actually really good. Okay. So in total for that time frame, per year, I would have made $189,000 just from this real estate property without doing anything more than just collecting the rents, paying the mortgage as it was due, and just sitting on the appreciation. That's massive. Okay. So now the next part is let's run it with the increased amortization. So this one here was with the 25 years. Okay. So let's go to 30 years and let's see what happens in 30 years. Okay. If we were to increase it by 5 years. Okay. So our cash flow. Okay. So now instead of the, okay, so let's go back to here. So we're going to increase the 25 to 30 years. Okay. So that changes our monthly payments by $500. Okay. So let's go here and we're going to say it's going to equal 100,000, 2, 3. Okay. Plus $500 times 12. Okay. Because basically what we've done is we've now pocketed an extra $500. Okay. So, you know, I'm starting with $100,000. It's just saying, okay, you know what, based on some previous projects I've seen, 100,000 is a reasonable number for the cash flow at the end of the year. Okay. So if I'm able to keep another $500 every single month, that adds $6,000 to my cash flow. Now my mortgage pay down though, instead of it being 114 divided by 5, it's going to be 8234. Okay, so let me just copy that number. Let me see if I can do that. Okay, I'm just going to put that number in. Okay, there we go. Divide that by 5. Okay, so now let me put that $sign there. So now instead of having a mortgage pay down of $22,008, I only have a mortgage pay down of $16,400. Okay, now the appreciation is still going to be the same. Okay, because it's based on based on the value of the building less the original value of the building. Okay, so that means the appreciation would be the same, 0% forced appreciation. So now I'm going to copy that sum over. Okay, so there's a minor difference here. Okay, so what is that difference here? Okay, so there's about a $323 difference per year. Okay, so that's not a big deal. As you can see, like, you know what, that's 12. Yeah, so like $300 a month. No, sorry, $30 a month that we're talking about here. So not a big deal in the scheme of things. Okay, so maybe going from 25 to 30 years, you know, whether you're an investor or not, it doesn't make that big of a deal. Okay, which is what this is saying. Okay, so now let's go up to 50 years and let's see what difference that makes. Okay, and so what this tells me is from an ROI point of view, it's actually not that bad, right? To go, like, if the lenders are going to give you 30 years, take the 30. Okay, because there's ways that you can pay down your mortgage faster so that you have more mortgage pay down than this. Yeah, because what's happening is that instead of the mortgage pay down, you're actually getting more cash flow. Okay. Okay, so now let's go to 50 years on here and let's just see how big of a difference that makes, because we're almost doubling it now. Okay, so the cash flow is, see here, so we're going to go, let me go back to 25 years so I can see. Yeah, so 5,800. So if I go to 50 years, it's 4,005. So that's about 1,300. So I'm going to, 1,300. So I'm going to go 1,300 times 12. So that increases my cash flow per year by $15,000. That's fantastic. Now let's see what my mortgage pay down is. So that's 25,000. So I'm going to copy 25,000 over, and then I need to divide that by 5. Okay, so I'm going to go here. Okay, 25,000 divided by 5. Okay. So now my mortgage pay down, instead of seeing a $22,000 or $16,000 mortgage pay down, I'm only seeing $5,000 a year, which is significant. Okay, so now the appreciation is still going to be the same, right? Yeah, because that's the amount. So now here we're saying, okay, so that is not going to be that. Okay, so where is it? Okay, so now the difference here, so each year we're still making about 187. Okay, so I'm going to go take this 189 minus 187. Okay, so the annual difference between having a 25-year M and a 50-year M is only $2,000 a year. Okay, so in the whole scheme of things, when you look at it this way, it's not that big of a deal. Okay, now it'll be interesting because I'm going to mold this over here a little bit more, and maybe next Monday I'll report back about what I might be missing here, right? Because when you look at it from a year-to-year basis, it doesn't seem like a big deal, right? It's like $300 or $2,000 over the course of the year, because you're able to keep $15,000 in cash and have that now to use, right? To potentially, live off of or do other investments with, right? So that's really good. So the thing that I want to see here, so 50 years, okay, your outstanding balance is that, yeah, see, so you're at 5% here. So that's really good, right? So your interest paid at this point after 5 years is 244. Whereas if it was 25 years, we're talking about a 10K difference. So not that big of a deal, right? And then if we go, let's see, the total interest paid, for that total amount of interest paid over the course of the loan, right? So $640,000 on $1 million, right? That's how much interest. So, you paid, so you basically bought 1.5 of your building, basically, at 25 years. So let's go to 50 years and see what that is. Yeah, see, so it basically cost you another $130,000 over that 50 years. Right. So, if it means that you can get into an opportunity and because the monthly payments are lower, then, having that 50-year amortization is fantastic, and looking at it from this point of view with the annual profit not being that big of a difference between the 25 to the 50 years, why wouldn't you take the longest amortization possible? Okay, so that is it. Okay, so thank you very much, everybody, for watching. If you had any ahas, if there's anything that jumps out of you, please put it down in the comment box. Let me know what you think about this session. This was an eye-opener for me to realize, hey, you know what? Increasing your amortization to get that cash flow might make a lot of sense, because at the end of the day, your ROI is going to be pretty much the same. So, okay. All right. That is it for me, everybody. Thank you so very much and have a great night.